Welcome to the TAC Index AI Podcast Weekend Edition, your shortcut to being well-informed. We blend TAC Index data, reports, and charts with the latest news in all things logistics, with a sharp focus on air cargo.
That's right.
Today, we're doing a deep dive into the dynamic world of air cargo and its broader market impacts. Our mission is pretty simple. Unpack this week's crucial updates and connect them directly to the wider macroeconomic picture for you.
Yeah, and it's incredible, really, how even seemingly small shifts in air freight rates or policy changes can send pretty significant ripples through the global supply chain and the economy overall. We're going to explore that interconnectedness today, showing how these elements truly affect the flow of goods and, importantly, what it means for capacity.
Okay, let's dive right in then. The latest data from TAC Index, the leading price reporting agency for air freight, for the week ending August 4th, the overall global air freight prices saw a slight easing.
A little lower, yeah.
The global Baltic air freight index, the BA00, it dipped by just over 1%, down 1.1% for the week.
Okay.
Now, that might sound small, but it leaves it about almost 2% lower year over year, minus 1.8%.
Right. And this slight ease, especially during what's usually a quieter season for air cargo, well, it already hints at some underlying pressures, doesn't it?
It does.
That slight downward movement, especially in this, traditionally low season, it isn't just organic market stuff. It's playing out against this backdrop of renewed uncertainties. We're seeing it influenced by macro factors, like those higher tariffs announced by U.S. President Trump.
Right, the tariffs. We'll get more into that.
Exactly. So the real question is, how much are these bigger economic and political headwinds already sort of baked into those weekly air freight numbers we're seeing?
Yeah, and how much more could they impact capacity and rates going forward?
Yeah.
Are we seeing evidence of that tariff impact already in specific lanes, or is it still more of a general sentiment?
That's what we need to unpack.
Let's dive into the regional breakdowns and see. First up, Asia outbound. The major lanes out of China to both Europe and the U.S., they saw rates ease a bit week over week.
A slight softening there.
Yeah. And we also saw dips on some newer lanes from North Asia to Australia and Spain.
Ah, interesting. New lanes popping up.
But here's where it gets interesting. Rates were actually higher week over week on another new lane, this one to India.
Oh, okay. India showing strength.
And notably, rates are still up year over year to all three of those newer destinations, Australia, Spain, and India.
So despite the week-on-week dips for some, the longer-term trend for those specific new lanes is still positive year over year. That's quite telling.
It is. Looking at the broader indexes, Hong Kong, the BAI 30, was lower by 1.7% week over week. It's down about 8% year over year. Shanghai, the BAI 80, had a smaller dip, just minus 0.2% week over week, leaving it down just over 3% year over year.
So Shanghai holding a bit firmer than Hong Kong recently?
Seems like it. And rates out of Vietnam also continue to be lower week over week to both Europe and the U.S.
What this nuanced performance across Asia tells us is, well, while some major traditional lanes are softening a bit, those increases we're seeing to places like India suggest specific pockets of demand are still pretty resilient.
Right. It's not a uniform picture.
Not at all. It points to a diverse, kind of complex market landscape. It's not just a simple story of a global slowdown. It feels much more granular than that.
So maybe businesses strategically shifting supply chains or exploring new markets?
Could be. And that directly influences where air cargo capacity is needed most. It's not evenly spread.
Makes sense. Okay, let's move over to Europe. We saw some intriguing shifts there, too.
All right.
Rates from Europe were actually a little higher week over week, heading to China and Japan.
Oh, interesting. Upward movement there.
Yeah. But they did come down week over week going to the U.S. However, they remained significantly ahead year over year on those transatlantic routes, at least in dollar terms.
Still strong year over year, despite the weekly dip. That transatlantic lane has been quite robust.
It has. Now, Frankfurt's index, the BAI 20, it saw a pretty sharp drop. It shed 11.6% week over week.
Wow, that's significant.
Yeah, dragged down by declines on most major lanes out of there. But it still held a gain year over year, plus 4.9%.
Okay, so a big weekly drop, but still up on the year.
Exactly. Meanwhile, London's index, the BAI 40, actually gained. It was up a solid 2.1% week over week.
So the opposite of Frankfurt.
Right. Reinforcing recent gains, actually, and leaving London ahead by a really robust 28.3% year over year.
28%. That's huge. If we zoom out a bit, that different, the divergence between Frankfurt and London, plus the continued strength on transatlantic routes. It really highlights how regional economic factors and specific trade flows are creating very distinct rate patterns, even within the same continent.
Yeah, absolutely. What could be driving that difference between Frankfurt and London, do you think?
Well, Frankfurt's decline could be tied to specific industries, maybe automotive or manufacturing slowing down there. Whereas London's resilience, maybe it points to different demand drivers. Financial services, e-commerce, perhaps a more consolidated market just maintaining its strength. It's hard to say for sure without digging deeper.
That makes sense. It really emphasizes how localized conditions play such a critical role in shaping these global air cargo flows, and crucially, where capacity is being utilized most effectively, or where it's perhaps under pressure.
Exactly.
Okay, and now for the U.S. picture.
Let's hear it.
Out of the U.S., rates were lower again, heading to China, but they were firmer on most other major lanes,
Okay.
notably to Europe and South America, including that new lane we mentioned added recently to Brazil.
Ah, Brazil.
Chicago's outbound index, the BAI 50, gained a pretty robust 12.0% week over week.
12% gain. Strong.
Yeah, lifting it back into positive territory year over year as well at plus 10.2%.
Okay, so Chicago bounced back nicely.
It did. And a consistent standout here is the strength of rates from the U.S. down to South America. They're still over 40% up year over year.
40%? That's remarkable persistence.
Driven by further gains on those busiest southbound lanes, especially out of Miami.
This consistent, really considerable strength in U.S. outbound routes, particularly to South America, it really begs the question, what is driving this? Is it shifting trade relationships? Is it just incredibly resilient demand in that corridor, maybe for specific goods? Or are companies perhaps rerouting supply chains somehow to avoid issues elsewhere?
Could be a combination of things.
Possibly. But this kind of sustained demand in one specific area, even while the broader global market might be easing, well, it indicates a fundamental need for air cargo capacity there that seems less susceptible to the general market slowdown.
That's a great point. Okay, so we've touched on those renewed uncertainties over higher tariffs mentioned in the TAC index report. This is where the macro picture really starts to bite, isn't it? We're seeing new reports that shed light on how these trade policies are directly influencing global logistics, market demand, and maybe even the capacity available.
Absolutely. The critical question becomes, how do these policy shifts, these tariffs, directly influence air freight demand and the overall trade flows? Because that impacts everything, right? From available capacity and how it's used right down to longer-term business investment decisions.
Yeah, the ripple effects.
Understanding that connection is absolutely key if you want to try and forecast future movements in air cargo.
So let's look at an example. Japan, for instance.
Okay.
They're actively pushing the U.S. to swiftly implement measures from a bilateral trade deal. This involves lowering tariffs on things like automobiles and auto parts down to 15% from, I think it was 27.5%.
Quite a drop.
And other Japanese goods down from 25% to 15%.
Oh.
But as their top trade negotiator pointed out, there's a big sticking point.
Oh, what's that?
Japan wants assurance against stacking tariffs.
Stacking, meaning?
Meaning adding new tariffs on top of existing ones, particularly for goods that are already above that 15% rate.
Ah, okay, so they don't want multiple layers of tariffs applied.
Yeah, exactly. Now, the Federal Register apparently confirmed a no stacking condition for the EU, but no such clarification was given for Japan.
That's not ideal for them.
No. And some reports, like one from Japan's Asahi newspaper, even suggest the U.S. will indeed stack these tariffs on Japanese goods. So it's creating a lot of uncertainty for businesses there.
Well, the really intriguing or maybe worrying aspect of this is just the sheer uncertainty and the lack of finalization, even when there seem to be agreements.
Right. It's not settled.
As one expert noted, this confusion plus the president's willingness to adjust tariffs quite spontaneously, it means that uncertainty over market access is becoming like a defining feature of this emerging economic order.
And that has knock-on effects.
Huge knock-on effects. For business investment, for hiring decisions, for prices, all critical for global logistics. Companies get understandably hesitant, right? They don't want to commit to long-term production or shipping plans if the rules of the game might just change overnight.
Which directly impacts their need for stable air cargo capacity. They might hold back.
Precisely. Or they might suddenly need capacity if a tariff gets lifted, or maybe shift modes if one gets imposed. It makes planning very difficult.
And it's not just Japan. The U.S. made other big tariff announcements, too.
Like on India.
Yeah, President Trump imposed an extra 25% tariff on Indian goods. The reason given was accusing India of helping prolong Russia's war by buying Moscow's crude oil.
Okay, so using tariffs as a geopolitical tool there.
Seems like it.
Hmm.
And there's also been talk, maybe just talk for now, of a 100% tariff on some chip imports.
Wow, 100% on chips that would be a massive disruption globally.
Absolutely, for the entire electronic supply chain.
Hmm.
But despite that initial tough talk from the administration, no exemptions, no exceptions on these country-specific tariffs,
Yes.
we're actually seeing quite a number of carve-outs already being approved.
Oh, really? So exceptions are being made?
Yes. Dozens of exemptions have been granted for various products, things like Brazilian orange juice, Chilean copper.
Okay.
Brazil, for instance, saw major exports like airplanes, some metals, fuels. They got excluded from a 50% tariff. That apparently accounted for about 43% of its exports to the U.S.
That's a pretty significant exclusion for Brazil, then.
It is. And similarly, Chile, a major copper supplier to the U.S., they succeeded in getting relief from a 50% tariff on their copper imports. So it's a very fluid situation, not as clear-cut as all or nothing.
Right. In the bigger picture, we're clearly moving from that initial no exemptions stance to, as one former official put it, limited exemptions, especially for products that cannot be made here.
They can't make it here argument.
Exactly. And this continuous push you see from countries like South Korea, Cambodia, they're trying hard to secure carve-outs for their strategic goods, whether it's aircraft components or garments. It really shows how intensely nations and companies are working behind the scenes to try and maintain some supply chain stability and market access.
And all that directly influences the volume and the type of goods moving through air cargo networks, right?
Yeah.
And the capacity needed.
Absolutely, because specific industries or product categories can suddenly find themselves in or out of the tariff crosshairs. One week you need capacity, the next maybe less so, or for a different product. This constant adaptation really affects planning for airlines and freight forwarders. They need to be nimble.
Okay, so tariffs are a major external factor impacting demand and potentially capacity needs. Let's talk about an internal one now, something that hits an airline's bottom line directly and feeds into your freight costs. Fuel.
Ah, yes. Jet fuel. Always critical.
What do the current oil market dynamics mean for flying cargo? West Texas Intermediate Crude, WTI, recently slid about 1.7%, settled near $65 a barrel. Is that good news for costs?
Well, yes and no. A key takeaway here is that this recent fall in oil prices seems partly linked to maybe the possibility of a Russia-Ukraine air truce, which could, ease crude supply risks a bit.
Okay, so a potential easing of geopolitical tension.
Potentially, but, and it's a big but, the market remains incredibly volatile. You still have Trump's threats of secondary sanctions against Russia looming. You have India and China playing significant roles as major buyers of that discounted Russian crude.
Right.
These things are constantly influencing prices, as BP CEO apparently noted. It's pretty hard to predict what's going to happen between all these different factors. Russian sanctions, Iranian sanctions, Chinese storage levels, and then just the underlying fundamentals of the oil markets themselves.
It sounds like a complex web.
It really is. So that volatility means predicting jet fuel costs remains really tricky, even if we see these short-term dips like the one near $65.
Right. A dip today doesn't mean lower prices tomorrow necessarily.
Exactly. And we also learned that crude prices have sort of held up in recent months, partly because inventory buildups haven't really appeared near the vital pricing points, like Cushing, Oklahoma. Instead, they've been concentrated more in China.
So the inventory is building, but maybe not where the market typically looks for its price signals.
Kind of. That concentration in China rather than broader global hubs, it makes the price signals maybe less clear, adds another layer of complexity for forecasting global operational costs for airlines.
So it really makes you wonder, doesn't it? How do these fluctuating energy costs ultimately impact the airline's operational expenses, and then, by extension, the air freight rates that we see from TAC Index?
That's the million-dollar question, isn't it? I mean, obviously, lower oil prices can ease cost pressures that might make air cargo a bit more competitive against, say, ocean freight, at least in the short term.
Sure.
But the ongoing geopolitical uncertainties, the volatility, they make long-term forecasting incredibly difficult for logistics providers.
So they have to stay flexible.
Totally. It forces them to constantly adapt their pricing strategies, how they manage their capacity. They have to know that a sudden spike in fuel cost could just wipe out their margins if they're not careful, and they might need to adjust surcharges pretty quickly.
So wrapping this week up, our deep dive into the TAC index data, combined with these insights from global trade policy and the energy market. It really underscores how air cargo logistics is navigating a very complex, often unpredictable landscape.
It really does.
We've seen this mixed bag in freight rates across different regions, even during a traditionally quiet season. And it's all set against this fluid backdrop of tariff negotiations and volatile oil prices, all of which, as we've discussed, directly impact global capacity and how it's used.
Indeed. This deep dive really emphasizes that, knowledge is most valuable when you understand it and can apply it. The interconnectedness of trade policy, energy prices, logistics. It means even seemingly small shifts can create pretty significant ripple effects in the broader macro market. It directly influences the global movement of goods, the capacity available to move them. It really is a constant dance between supply, demand, and these big geopolitical influences.
So, thinking ahead then, given these ongoing, very fluid tariff negotiations in the still volatile energy market, what surprising shifts might we perhaps see in global trade lanes or air cargo demand as countries and companies continue to adapt to this evolving economic order? What stands out to you the most about how all these elements intertwine and affect the movement of goods around the world?